Liquidity ratios, a key tool for assessing bank liquidity. When it comes to managing risk, maintaining adequate liquidity is crucial for banks. Liquidity ratios are a key tool for assessing a bank's ability to meet its short-term obligations. In this video, we'll explore 3 important liquidity ratios that banks use to monitor their liquidity position. 1. Current ratio. The current ratio is a basic measure of a bank's short-term solvency. It is calculated by dividing the bank's current assets by its current liabilities. A higher current ratio indicates a greater ability to meet short-term obligations. However, an excessively high current ratio may suggest that the bank is not effectively deploying its assets. 2. Cash ratio. The cash ratio measures a bank's ability to cover its short-term obligations with its readily available cash and cash equivalents. It is calculated by dividing the bank's cash and cash equivalents by its current liabilities. A higher cash ratio indicates a higher level of liquidity and a stronger ability to meet short-term obligations without relying on other assets. 3. Loan-to-deposit ratio. The loan-to-deposit ratio measures the relationship between a bank's loans and its customer deposits. It is calculated by dividing the bank's total loans by its total customer deposits. A lower loan-to-deposit ratio suggests that the bank has a strong deposit base and is less reliant on external funding sources. This indicates a higher level of liquidity and stability. Monitoring these liquidity ratios is essential for banks to assess their liquidity risk and make informed decisions. Banks with low liquidity ratios are more vulnerable to liquidity shocks and may face difficulties meeting their obligations in times of financial stress, potentially leading to financial instability. By regularly analyzing liquidity ratios, banks can identify potential liquidity issues and take proactive measures to manage their liquidity position. This could include adjusting lending practices, managing deposit inflows and outflows, or accessing alternative funding sources to maintain adequate liquidity levels. In conclusion, liquidity ratios are a fundamental tool for assessing a bank's liquidity position. Banks must carefully monitor these ratios to ensure they can manage their short-term obligations effectively and maintain financial stability. Want to learn more? Claire Trithel on LinkedIn